Good afternoon, everyone. My name is Adrian, and we are from Group 4, and we will be present Chapter 19 about cash and liquidity management. This is our group member, and this is our table of contents. And then, the reason for holding cash. So there are some reasons why firm holding cash. The first one is speculative motive. The speculative motive is the need to hold cash in order to be able to take advantage of, for example, bargain purchases that may arise, attractive interest rate, and in this case of international firms, favorable exchange rate fluctuation. And then the next reason is precautionary motive. So the precautionary motive is the need for a safety supply to act as a financial reserve or for emergency needed by the firms. And then the third reason is transaction motive. The transaction motive is the need to hold cash to satisfy normal disbursement and collection activity associated with the firm's ongoing operation like their bills and etc. And the last is compensating balance. So a firm generally has to hold cash balance to compensate its banker for the service provided. And then there is a cost of holding cash. So when a firm holds cash in excess of some necessary minimum, it incurs an opportunity cost. The opportunity cost of excess cash held in a currency or bank deposit is the interest income that could be earned in the next best use, such as investment in marketable securities. Okay, so the next part will be continued by other member of my group, and thank you.
Hello everyone, my name is Agatha and I will discuss about float. Float is the difference between cash balance recorded in the cash account and the cash balance that are recorded in the bank. So there are two types of float. The first one is this disbursement, and then we also have collection float. So checks written by a firm generate disbursement float, and it will cause a decrease in the firm's book balance, but it will have no change in its available balance. And if the float is positive, it is disbursement float. And then if check received by the firm, it is a collection float and it will cause an increases in a book balance, but not immediately change available balances. And if the float is negative, it is a collection float. And the net float is the overall difference between the firm's available balance and its book available balance and its book balance. And for example, suppose you have a $5,000 on a deposit, and one day you write a check for $1,000 to pay for your books, and then you also deposit a $2,000 of check. And then what are your disbursement and collection and a net float? So after you write a 1,000 check, your book will show a balance of $4,000, but the bank will show $5,000 while the check is clearing. And then the differences is the disbursement float of $1,000. And then after you deposit a $2,000 of check, you show a book balance of $6,000. And your available balance doesn't rise until the check clears. So this will result in a collection float of minus $2,000. And then your net float is the sum of the collection and the disbursement float, which is minus $1,000. And then we also have a float management. So the objective in a cash collection is to speed up collections and reduce the lag between the time customer pay their bills and the time the cash become available. Total collection or disbursement times can be broken into three parts. The first one is the mailing time. It is like a part of collection and disbursement process during which checks are trapped in the postal system. And we also have processing delay. It is the time it takes the receiver of check to process the payment and the deposit in a bank for collection. And then the last one, we also have availability delay, which refers to the time required to clear a check through the banking system. And the size of float depends on the dollar amount and the time delay. So the delay is equals to mailing time plus processing delay plus availability delay. So for example, suppose you email a check for 500,000 $500 to another stage each month, and it takes 5 days in the mail for the check to reach its destination. or it is called as the mailing time. And then there is also 1 day for the recipient to get offered to the bank. It is a processing delay, and the recipient's bank holds out of the state check for 3 days or its availability delay. So the total delay is 5 plus 1 plus 3 equals to 9 days. In this case, what is your average daily disbursement float? There are two equivalent ways of calculating the answer. First, you have a $500 float for 9 days. So we say that the total float is 9 times $500 will equals to $4,500. Assuming in a month there are 30 days, so the average daily float will be $150 for each day. Alternatively, your disbursement float is $500 for 9 days out of the month, and for the rest 21 days it was equal to 0. So your average daily float is 9 times $500 plus 21 times 0. And the sum of it will be divided with 30, that equals to $150. This means that on an average day, your book balance is $150 less than your available balance. So the next example is the cost of the float. Cost of the float is opportunity cost of not being able to use the money. Suppose the average daily of the float is $3 million with a weighted average delay of 5 days. What is the total amount of unavailable to earn interest? So it's just simple. 5 times $3 million will equals to $15 million. And what if we want to reduce the delay by 3 days, but it costs us $8 million? So we just calculated the immediate cash inflow first. It is 3 days times $3 million, and it equal to $9 million. And then the NPV will be $9 million minus $8 million, and it will result to $1 million. That's all from my part. Thank you for listening.
Hello, everyone. I will now explain about cash collection. Now, from the previous slides, we know that collection delays work against the firm, and the point of cash collection is to speed up the collection time. And I will be explaining about the different processes and methods that are able to shorten and manage the cash collection process. Now, the overall cash collection process is separated into 3 segments. First is the mailing time, followed by the processing delay, and third would then be the availability delay. Now, one thing to keep in mind for this whole process is that it is all entirely dependent on 2 factors within the firm, which is the distance between the firm, and the bank, and the firm's efficiency in collecting the cash. Afterwards, when the funds are all secured and received, the collection process would become relevant, and the firm then deposits their funds into 1 or more locations. Now, the first system I would like to talk about is the lockbox system, which is a special mailbox that allows a faster and easily managed collection process. Now, the process starts with the customer sending their checks to the post office rather than to the firm. Afterwards, the bank would then collect the funds and proceed to process it and deposit the firm, and the firm would then process the funds as receivables. Now, the process is sped up since the collected cash gets sent to the bank to be processed and deposited immediately, instead of the firm doing it themselves and reducing the mailing time altogether. One thing to note is the new, or rather current, approach of electronic lockboxes, where it's more common to have customers pay using the telephone or internet and having the transaction be authorized without any pen and paper. Next, we also have the concentration system, which is a practice of having multiple cash collection points as a result of owning multiple banks and accounts that goes to the firm's main account. And by pooling its cash together, The firm would then be able to manage its cash management easier, as well as providing a larger amount of funds to help negotiations of short-term investments. Another small thing to note is that while these are all different processes to speed up the cash collecting, they're not all mutually exclusive. And in fact, the lockbox system is often used together within the concentration system. Sorry. Now, now the concentration system is made up of 3 different processes to handle its transfers. One is the DTC, which is the depository transfer check, which is a pre-printed check that's only valid for transferring funds between the same firm, and only requiring 2 days until it's available and no need of a signature. The second is the ACH, or the automated clearinghouse, which is basically an electronic check that allows cash to be used however way that is available. And the next with the cost of the process being more expensive. And finally, we have the wire transfer, arguably the most expensive process that allows for instant availability. Overall, these transfer processes are chosen dependent on the number and size of payments a firm receives. Now, a good example of what I just explained is this. Let's say a company in Atlantic is considering a lockbox system, since their collection days are currently tied to 8 days. And the bank promises a lockbox system that will shorten their collection time to 6 days. Here's the proposed system, which is that it reduces the mailing time by 1 day and reduces the clearing time by 0.5 and the firm processing time by 0.5 days. And as you can see from the time chart, this provides a significant boost where it mainly eliminates the processing delay and has it available on the same day, while also reducing the mailing time by 1 day and potentially boosting the average daily collections by 2. Okay, I think that's all from me. Thank you very much.
Okay, my name is Ammar Maulana Afiff, and I'm going to present about the managing cash disbursement. So what is cash disbursement? So cash disbursement is the cash that used to pay out to individual for the purchase of items that are needed and used by a company. So for example, when we purchase an equipment and we pay the equipment, that could be considered as a cash disbursement. So the next thing that I want to discuss is about the disbursement float. So in the point of view of firm, slowing down the disbursement float is desirable or beneficial because the firm can hold the cash longer. So why is it beneficial for the firm to hold cash while holding the cash longer? So if we hold the cash longer, that means we could invest the cash longer too. That if we can invest the cash longer, then we could earn more money from it. So there are 3 ways to increase the disbursement float. For example, one of them is to increase the mail float. The second one is to increase processing float. The third one is to increase availability float. So for example, we have 2 companies, company A in Jakarta and in company B in Papua. And we buy the supply from Jakarta. However, we make the check in company B in Papua and deliver the check from Papua to Jakarta. And this could be considered to slowing down the disbursement float because we have the option to make the check in Jakarta. However, we choose to make the check in Papua. That will take much more time to deliver the check longer to the suppliers. Also, the slowing down the disbursement could be considered to be unethical and not optimal. Why is it unethical? Because in the point of view of the suppliers, they want to get the payment as soon as possible. So if the company is slowing down the disbursement float on purpose, it could build a bad relationships with the suppliers and with the firm. So the second thing is not optimal. Why is it not optimal? Because when we buy something from the supplier always sometimes give us a discount to the firm if we pay the payment faster. So that's one of the things that we need to consider. So the next thing that I'm going to discuss is about controlling disbursement. So the controlling disbursement is very important because we need to know how many cash that we need to hold. If we hold too many, then we will invest less. But if we don't hold enough, we need to find a way to pay the cash by using the short-term debt. So what's the way to do this is by using the zero balance account. That is a disbursement account in which the firm maintain a zero balance, transferring funds from master account only as needed to cover checks presented for payment. So these are the image of between the no zero balance account and the 2 zero balance account. We could see that in the no zero balance account, the safety stocks is divided into two. The first one is the payroll account and the second one is the supplier accounts. However, if we use the 2 zero balance account, we only need one safety stock and one master account, and we divide the cost by the cash transfer by in the payroll account and the supplier account.
Hello, my name is Pramudito Harjo Widodo. I'm going to continue the presentation. Now, moving on to investing idle cash. If a firm has a temporary cash surplus, it can invest in short-term securities. So, the market for short-term financial assets is called the money market. The majority of short-term financial assets that trade in the money market is 1 year or less. Most large firms manage their own short-term financial assets, carrying out transactions through banks and dealers. Some large firms and many small firms use money market mutual funds. These are funds that invest in short-term financial assets for management fee. The management fee is a compensation for the professional expertise and diversified caution provided by the fund manager. Among the many money market mutual funds, some specializes in corporate customers. In addition, banks offer arrangements in which the bank takes all excess available funds at the close of each business day and invests them for the firm. Temporary cash surpluses. Firms have temporary cash surpluses for various reasons. Two of the most important are the financing of seasonal or cyclical activities of the firm and the financing of planned or possible expenditures. The first one is seasonal or cyclical activities. Some firms have a predictable cash flow pattern. They have surplus cash flows during part of the year and deficit cash flows the rest of the year. For example, Toys R Us, a retail toy firm, has a seasonal cash flow pattern influenced by the holiday season. A firm such as Toys R Us may buy marketable securities when surplus cash flows occur and sell marketable securities when deficits occur. Of course, bank loans are another short-term financing device. The use of bank loans and marketable securities is to meet temporary financing needs. The second one is planned or possible expenditures. Firms frequently accumulate temporary investments in marketable securities to provide the cash for a planned construction program, dividend payment, or other large expenditure. Thus, firms may issue bonds and stocks before the cash is needed, investing the proceeds in short-term marketable securities and then selling the securities to finance the expenditures. Also, firms may face the possibility of having to make a large cash outlay. An obvious example would involve the possibility of losing a large lawsuit. Firms may build up cash surpluses against such a contingency. So, this figure shows short-term financing policy. The light blue part is short-term loans and the blue part is held by marketable securities. So, as you can see by this example, in time 1, a surplus cash flow exists, seasonal demand for assets is low, and the surplus cash flow is invested in short-term marketable securities. And in time 2, a deficit cash flow exists, seasonal demand for assets is high, and the financial deficit is financed by selling marketable securities and by bank borrowing. So, given that a firm has some temporarily idle cash, a variety of short-term securities are available for investing. The most important characteristics of these short-term marketable securities are their maturity, default risk, marketability, and taxability. The first characteristic is maturity. From Chapter 7, we know that for a given change in the level of interest rates, the prices of longer maturity securities will change more than those of shorter maturity securities. As a consequence, firms that invest in long-term securities are accepting greater risk than firms that invest in securities with short-term maturities. We call this type of risk interest rate risk. Firms often limit their investments in marketable securities to those maturing in less than 90 days to avoid the risk of losses in value from changing interest rates. Of course, the expected return on securities with short-term maturities is usually less than the expected return on securities with longer maturities. The second one is default risk. Default risk refers to the probability that interest and principal will not be paid in the promised amounts on the due dates or will not be paid at all. In Chapter 7, we observed that various financial reporting agencies compile and publish ratings of various corporate and other publicly held securities. These ratings are connected to default risk. Of course, some securities have negligible default risk, such as the U.S. Treasury bills. Given the purposes of investing idle corporate cash, firms typically avoid investing in marketable securities with significant default risk. The third one is marketability. Marketability refers to how easy it is to convert an asset to cash. So marketability and liquidity mean much the same thing. Some money market instruments are much more marketable than others. At the top of the list are US Treasury bills, which can be bought and sold very cheaply and very quickly. The last characteristic is taxability or taxes. Interest earned on money market securities that are not some kind of government obligation, either federal or state, is taxable at the local, state, and federal levels. U.S. Treasury obligations such as T-bills are exempt from state taxation, but other government-backed debt is not. Municipal securities are exempt from federal taxes, but they may be taxed at the state level.
Okay, and now I will explain about the V80 model. The Baumol-Allen-Stubbins model, or usually called V80 limitation classic model, is a classic means of analyzing our cash management problem. It will show how this model can be used to actually establish the target cash balance. It is a straightforward model useful for illustrating the factors in cash management and more generally current asset management. In the V80 model, the model assumes the constant net disbursement rate, and it's rarely the case in most industries. In the V80 model, it also uncertainties over both disbursement and inflows in many firms. In the V80 model, there's also no room for uncertainty, or the cash flow are replenished the instant when they run out. Okay, now the basic idea of the V80 model. Before we determine the optimal strategy, we need to know the following three things. First, the fixed cost of selling securities of X cash, or represented by F. And next, the total amount of new cash needed, or D, represented by T. And last is the opportunity cost of holding cash, or the interest rate, that represented by R. And based on the figure on the left side, we can see the V80 model. The V80 model cash balance figure. As we can see, if we start with C dollars, spend at the constant at each period and replace our cash with C dollars when we run out of cash, our average cash will be C per 2. And as we transfer C dollars on each period, we incur a trading cost of F dollars times T per C. And now, this is the formula of the V80 model. As we can see on the left side, you can see the formula for the opportunity cost, trading cost, the total, and for the total cost and the C star. The optimal cash balance is found where the opportunity cost equals the trading cost. So the opportunity cost is equals with trading cost and represented in the formula below. So we can also multiply both sides by C using the three formula below. Okay, and now this is the example of the V80 model question. The Vulcan Corporation has cash outflows of $100 per day, 7 days a week, for 7 days a week. The interest rate is 5%, and the fixed cost of the replenishing cash balance is $10 per transaction. And what is the optimal initial cash balance? And what is the total cost? As you can see, the total cash needed for the year is 365 days. So we multiply it with $100 and resulting in $36,500. From the V80 model, we have that the optimal initial balance is, and using the C star formula, we can get the $3.821. So we can also see the average cash balance is the 3.821 per $2 and resulting in $1.911. So the opportunity cost is 1.911 times 5% and resulting in $96. And since the full can needs $100 per day, the $3.821 balance will be last $3.821 per 100 and will be 38.21 days. The firm also needs to resupply the account of 1 year per $38.21 and resulting in 9.6 times per year. So the trading order cost is $96. So the total cost is $192.
Hello everyone. So my name is Putra Prawira, and here I'm going to explain to you a bit about the Miller-Orr model. So Miller-Orr model is a more general approach, and just like a BAT model, we also concentrate on the cash balance. And now we assume that this balance fluctuates up and down randomly and that the average change is zero. Now we get down to the basic idea of the Miller-Orr model. So as you can see from the graph, we have 3 points that we have to highlight. The first one is the U star, which stands for the upper control limit. Second one is the L, or the lower control limit. And the third one is the C star, which is the target cash balance. Now the idea here is that when the cash balance reaches the upper limit, or here shown by point X, the firm will move by U star minus C star dollars out of the account and into more marketable securities. And while the other one is when the cash balance reaches the lower limit, or shown here in point Y, the firm will sell by C star minus L worth of securities and deposit the cash in the account. And this action takes the cash balance up to C star. And as long as the cash balance is between L and U star, there will be no transaction made. Now we talk about the math. So basically there are 3 formulas in Miller-Orr model. The first one is to calculate the C star, and which is the target cash balance. So the formula is the cubic root of 3F and the variance of net daily cash flow, and divided by 4R plus L. So the F is the fixed cost and the R is the opportunity cost, and while the L is the lower control limit. And for the L, or the lower control limit, is usually given by the firm. Next, the second formula that we can calculate is the upper control limit, or the U star. So the formula is 3C star minus 2L. And that's how we can get the U star. The third formula is to calculate the average cash balance in this Miller-Orr model. So as you can see, it's just the 4 times C star minus L divided by 3. And we can get the average cash balance. Now here is the example taken from the book. So suppose F, or the fixed cost, is $10 and the interest rate, or the R, is 1% per month, and the standard deviation of monthly net cash flows is 200. From this information, first we can calculate the variance, and the variance is here is just the standard deviation to the power of 2. So the standard deviation is 200. To the power of 2, we can get $40,000 US. And another information that we are given is the L, or the lower control limit, is 100 US dollar. So sorry, for the C star, from the C star we can get that just by using this formula. We just plug in those numbers here, and for the L here, the L is 100, the F is $10, and for the variance is 40,000. We can get the C, or the target cash balance is 411 US dollars. And for the upper limit, or the U star, same, we just use this formula, which is the 3 times C star minus 2 times L. So the C star, we get that from here, that we just solved before, which is 411. And for the L is given is 100 US dollar, and we can get 1,033 US dollar. Finally, we calculate the average cash balance, and there would be, by using this formula, 4 times C star minus L divided by 3, and the C is same that we just calculate before. It is 411 minus L. The L here is given, which is 100, and we can get 515 for the average cash balance. So I think that's all in this explanation of Miller model, and next will be explained by my friend. Thank you.
My name is Magnus. Okay, now let's discuss the implication of the Bed and Miller-Orr models explained earlier. So, the Bed and Miller-Orr models stated the costs regarding the target cash balance. The first one, we can see that the greater the interest rate, the lower is the target cash balance. So, the larger the cash balance, then the larger also the opportunity cost of holding the cash. This happens because cash offer no return. And second one, the greater the order cost, the higher is the target cash balance. So order cost or trading costs typically have a fixed fees and not affected by the volume of the trade. So if you have a minimum cash balance and you trade often, the fees will be much higher compared when you just do one bulk trade. Besides that, the Miller-Orr model also concerned with the variation of the cash balance. We can see here, the greater the uncertainty or variance of the cash balance, the larger the gap between the upper limit and the lower limit. So we can see here, for example, if we make the variance bigger to the green arrow line, the gap between the upper and lower green line tend to be more divergent. And also, when using the Miller-Orr model, the manager also has to concern and do a calculation about what is the L, the lower control limit for the cash balance, the estimation of the standard deviation, the determine the interest rate, and estimate the trading cost of buying and selling the securities. And lastly, we talk about the other factor that influence the target cash balance. For additional consideration, borrowing cash is likely to be more expensive than selling marketable securities because the cost of borrowing fresh cash tend to have a high rate. And then regarding the need to borrow cash or to maintain a low cash balance, it depends on the management desire to hold those low cash balance. Then lastly, for large firm, often the trading costs are small compared to the opportunity cost of holding cash. So they have to watch out their uh, opportunity cost of holding cash more because they can invest it somewhere else for a while. For example, suppose that firm has $100 million cash and the trading cost is only $100, while the interest rate, daily interest rate is only 0.1%. So the opportunity opportunity cost is $100,000, and it's significantly more than the trading cost. Okay, I think that conclude our presentation. Thank you. We are from Group 4, covering Chapter 19.